Well, people, the SPX had one of its best months on record in November, and December came along, and we're kind of blissfully drifting higher as it stands, heading into some very big macroeconomic data, as well as the blackout period. So what does that mean for me and you and the retail traders? Well, we're going to be navigating the financial markets through the lens of technical and financial market analysis on today's Stock Market Brief Show. So let's go ahead and get into it. All right, people, welcome back to the show. Sorry if my mic's a little echoey. I'm in an empty office as it stands right now. This was released by B of A Securities, showing that the 4-week average corporate buyback since 2008 has reached a historical high. So we've been wondering, where's all the buying come from? CTAs and potentially corporate buybacks. Now, Goldman Sachs recently released this note saying that we are currently in the first week of the estimated buyback blackout period, which is expected to run through January 19th. So does that mean the big buyers are going to dissipate until 2024? And this is happening as we're leading into some very critical macro data. We have inflation data coming out tomorrow morning, an hour before the market opens up. The next day we have PPI and the Fed interest rate decision. So some big data points coming out. Thursday we have retail sales, and we have some other stuff there on Friday as well. This is all taking place, and as we head into this data, with the SPY and the Qs reaching their topper end of their bands. And this right here is an indicator that I like to use. I put it on a zone document for my Patreon group. And then the volatility index is reaching towards its lower band. And I like to look at this from a fractal perspective to see where markets currently are. Now, as this is taking place, I should note that the bands themselves have reached a very, very tight point in the markets. It's actually dating back all the way till 2021, late in the year. And markets, they move between expansion and contraction. So when this line goes down and gets these really low levels, it means the bands themselves are contracting very tightly, and that is taking place as the market's kind of been drifting sideways. So they're getting very tight, heading into big data, and we got these corporate buybacks at historical highs while we're entering the blackout period. It's a mix right there for potential explosive moves in the very near future. If you take a look at back month versus front month volatility, back month is over 20% above front month volatility, so the VIX is getting crushed. Back month is moving up. Sometimes we've seen periods of consolidation or even pullbacks in the market when this has taken place. Now, if we take a look here on the daily time frame of the SPX, we're not too far off from that all-time high. So we're going to have to get pretty tactical here as we just kind of have these low up days, and I'll kind of explain what that may be. Well, we're in a positive gamma territory still, people, and the gamma level right now is at 45.50. Now, this changed, so you want to come back and check it every once in a while on my show to see where it is. Now, in a positive gamma territory, that's where dealers look to sell into strength and buy into weakness. So you typically get, well, exactly what we're seeing. Now, in a negative gamma territory, if we start breaking from those levels, that's where we get selling upon selling and then buying upon buying, and you get much more volatile price swings. Now, this is the 30-minute time frame for the SPX. Going into tomorrow, we have a daily expected move of 46.52, and then down here at 45.92. You can download the chart deck for free, right? And you can get all of these levels. I have a lot of lines on the chart here, and I'll break them down. Okay. First and foremost, the purple line, it is inclining. What's the purple line? That is the 5-day moving average. When we're above it and it's inclining, that is a positive sign. When we're in positive gamma territory, that's also a positive sign for the markets. You want to be more cautious if it starts turning and declining and price gets under it. That's where you want to be a lot more careful and wait for price to confirm back to a short-term uptrend if you are a long investor. Now we have a couple other lines. We have this red line up here and this green line. That is just highlighting the technical channel that it's currently in. You can see we've tagged it, and we're blissfully drifting higher today, right actually where the daily expected move was and a important gamma level. That was today's daily expected move. Now, if you don't know what daily expected moves are, these are this is like a forward-looking indicator, okay, of risk for the markets. The markets themselves are using, options data, right? So this is taking the options data, implied volatility, and looking at what can the risk be for the following day. And then also we're looking at the weekly expirations for the following week. Now, when you think of this in terms of probabilities, right, 68% of the time, it closes within that risk, that deviation, right? So one standard deviation going into tomorrow, it's likely, so you have a 68% probability that we close within there. Now, if the data comes out, beats expectations or comes in lower than expectations, or it's more of a surprise, I guess we can say, maybe perhaps we go into 2 standard deviations moves where we tag the weekly expected move. Now, most of you might not know this, but the weekly expected moves we have not tagged for 2 whole weeks, and that is pretty darn rare. You'd have to go back pretty far in order to see where the market hasn't tagged one of these. So I personally believe we will be tagging 46.68 this week and or 45.40. And as it stands, we're in positive gamma territory. The 5-day moving average is inclining. So the likelihood is we drift up higher. However, remember, these are binary macro events, and binary macro events, just get ready for surprises because they can be explosive. Now, looking out to the highest call wall up here, we're starting to see a lot of activity take place at 4,700. So this can be a very key level to watch out for. The last one was 4,600, and we tagged it multiple times, and it broke off from that. And then we tagged it, we broke off from it, and finally we started pressing up higher into this gamma exposure level there. So positive gamma territory or above a rising 5-day moving average. We're in a little up channel, and well, the volatility bands are contracting. So just be ready, people. Let the market digest the news and see how it sets up. As it stands right now, you look to buy pullbacks and see if we can buy, and not only the pullbacks, but wait for strength after the pullback. So that's what it looks like right now. Now, there are many divergences still taking place in the market. There's very overbought conditions in the markets, and now we have big buyers leaving the market. So in these type of environments, I like to scale back my risk a little bit, be much more selective, and then approach the markets from a risk first perspective. That's what we always have to do, really. Now, looking at the Nisey-McClellan oscillator, this divergence that we called out a while ago has continued to build as the New York Stock Exchange, the NYA, continues to coil up in this rising wedge fashion, very similar to what we saw over here before we saw that dip, and then we saw those positive divergences. The last chart that I found to be quite interesting is smart money, which is the bond market, versus dumb money, right? We're using high yield on the 60-minute time frame, and then SPY, considered the retail, right? I mean, it's just the same. Don't get offended. HYG has put in a lower high in the short term, and the SPY has put in a higher high, and we've seen these divergences play out over time, and sometimes smart money can lead us to where dumb money may follow. What do I mean? Well, take a look over here where smart money, the HYG, was putting in a lower high, but the SPY was putting in a higher high. And what happened? Well, smart money led the way to the downside. Well, what about right here? Well, this is a positive divergence where the smart money put in a higher low and dumb money put in a lower low. So smart money was giving us insight, hey, we might actually see the market rally. So we have a current divergence that's building. Doesn't mean that it has to play out. If HYG breaks this high, well, then guess what? That divergence no longer matters. That's all I got for you on today's episode, everybody. Hope it helps out. See you later.